And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
Welcome to The Real Investment Show, Financial Fitness Friday edition. I'm Danny Ratliff here with John Penn. Thank you guys for joining us today. If you are in Texas or Houston specifically, it is Go Texan Day. Left my cowboy hat at home, guys. Or actually on the horse outside. But
put him in the stable out front?
In the stable, yeah. I mean, because that's what we do down here, right? We all ride horse. Now, however, the trail ride did end, and the rodeo is in full effect now. So I'm sure it's going to be a light morning here in Houston, considering everybody's at the World Championship cook-off this weekend. So I guess we can say and do what we want, John. So I figured we'll do some trivia today. We're just going to hang out and have a little fun.
Hey, actually, it's Go Texan Day. I actually wore jeans today.
You wore jeans?
I'm a rebel.
You're a rebel.
I live life on the edge.
I didn't see the cowboy boots, so I'm a little disappointed.
Yeah, I left those at home.
All right. Well,
I really don't own a pair. I'm just being full and honest here this morning.
I just figured you'd wear your cowboy Crocs.
That's it. Yeah, cowboy Crocs. Mm-hmm. Yeah.
Yeah, I haven't given up on life yet, so I don't wear Crocs. So seriously, though, real quick, before we jump into markets, you don't own a pair of cowboy boots?
Oh,
I know.
I don't. Yeah, I know. My wife's probably listening right now, and I am one of those. I am one of those. But yeah, I know it's a shame. I've been in Houston now for probably close to 25 years. I'll get some cowboy boots this year, Danny, and I'm going to wear them in here to the show.
We're going to make it happen. All right. Good.
A word of advice: buy some real boots.
Yeah.
Go to a real boot shop and get them done right. Otherwise, they're going to foul up your feet.
Yeah.
Just saying.
Yeah. You want to splurge on those. You don't want to go.
You
don't want to go chintzy on the boots.
Spend good money on boots. Yes.
Yeah, look, you can get married and you get buried in them. So,
Yeah.
That's kind of the way I look at it. But hey, so yesterday broke a tad bit of a streak, bounced off 50-day moving average. We did see markets respond well yesterday. Today, futures are pointing down as we're trying to digest a whole lot of data that's about to come out. So really looking at personal consumption expenditures this morning, this is going to be what the Fed typically looks at. And the inflation numbers, this inflation number is going to be very interesting to see where this goes, especially with the Fed back against the wall. I mean, they're so far behind the curve here. And, we'd initially thought that we were going to potentially see them start, stopping the rate hikes potentially in February, maybe March. Looks like they'll go through April, and odds are now that they'll likely go through June. These numbers today are going to be extremely important to figure out exactly what they're going to do. Looking at bond yields, bonds have been soaring. Did see the 10-year drop just a tad bit yesterday, finished today at 3.91. But the 2-year, which is really sensitive to the Fed rate hikes, is at 4.72. Mm-hmm. And this has gone up about 50 basis points just in the last month since February. And so we are seeing the yield curve is still very inverted. We were talking before the show, you can go out and get a 6-month T-bill at, well over a little bit over 5%. Mm-hmm. So interesting environment where, we still haven't seen this quite the risk off trade and environment that, we would usually see as rates begin to get a little bit higher. And I'm not sure if everybody's convinced that we're not going to see quite a bit more. So, target rate and terminal rate for what the Fed's looking to hike to has gone up a bit. And the issue now is, as we're continuing to, really understand what this data means and looking in the rearview mirror, as we've discussed, and then trying to remember that, where we're driving to, that's behind us. And it's the market's going to look out in front of us. Now, we are at a very critical point from a technical perspective, meaning that we could break down from here. But so far, holding support, futures aren't pointing positive as of yet. But I think if data shows maybe things are a little bit weaker, this may be that environment where good news is bad news and bad news is good news, because the Fed may pull off the accelerator a tad bit. I don't know, John. This is going to be something to watch for. And I don't have any predictions on this. Usually on the Friday shows, Rich and I will give a little bit of a...
Get your crystal ball out.
Man, it's been broken.
Yeah.
It really has on a short-term basis. I mean, this has been a difficult environment and really challenging. I think people are feeling it too, where this year we started off the markets on such a run. Going into the year, I think everybody was kind of down in the doldrums as the market in December didn't perform real well. Now, we've been in that technical bull market, at least changing the trend here for a moment. And, that's where we have to be cautious. Is this a head fake? Or is this a real move forward? And I don't think that, you're going to get the guys that say they know exactly what's happened. If they do, you need to be cautious, because this is an environment where you need to be prepared to call an audible and do so quickly, because these markets are changing. The Fed is changing quickly. If we look back just even a year, 2 years ago, the Fed was still on the transitory and that inflation's not very sticky. And man, it has been a lot more persistent than I think they even considered. And now, where does that target range change? They're shooting for 2% inflation. I don't see how they get there. We couldn't manufacture 2% inflation pre-pandemic for a decade, really. I mean, so what are you seeing right now, and what do you think about this current environment?
I would say at least the positive side of the Fed being so aggressive with raising rates, at least for the first time in a long time, you can earn a better yield on your cash or cash alternatives, right? At least.
Yeah,
right.
That's been great.
There's a lot of uncertainty with the equity market, I would say, and definitely the folks that I've been visiting with, yes, they're concerned about that. But, even our approach right now, Danny, and you know this, we have enough exposure to the market equity-wise, where if there is strength or there's positive performance, at least we can participate. But at the same time, we're still holding a pretty hefty percentage in cash and cash alternatives to take advantage of those higher yields. Plus, it gives us some powder so that if the market does deteriorate from here, we can buy things at a better value. We may not get the rock bottom price, but at least we can get investments at a better value than where they were before. But even 2 years ago, when I was visiting with individuals and families, and they were just looking for an area to park some cash, maybe they were waiting to buy a home or buy some land. They were saying, John, hey, I want to find something that I can put my money into that's liquid, my principal safe, and I'd like to earn about 3 to 4%. And at the time, it didn't exist. I would say, hey, if you can find that, let me know. But now, at least with the Fed raising rates, at least you have those available options for your cash balances. But to your point, Danny, I think the Fed has made it very clear that they're still on the path of taking the steps necessary to get inflation under control.
Yeah, I think that's exactly right. And so what does this mean for the average Joe out there? I mean, I think that this is important, that we don't make emotional or rash decisions. Market is still up for the year. So S&P is up about 4.5%. NASDAQ has been on a run up just over 10. So we've erased some of these gains, but the gains that we have actually seen this year already or typically would be what we consider a pretty darn good year for a full 12 months. And, we're looking at this on a calendar year basis, which is what most people do. However, we need to think of a little bit longer term with this. And now, we're not advocating necessarily buy and hold, but we also don't want to make those emotional decisions, because this is where we're getting a lot of feedback. And, it felt good for a bit, and now we're back in thinking, oh, shoot, is this thing about to get a whole lot worse? And it could. I think one of the bigger issues right now is that what actually happens. Is there something brewing out there that has more systemic risk than just a typical normal recession? That's what we have to guard against, is that what are the things that are not being considered, or that not being considered, but just nobody knows. It hasn't reared its ugly head quite yet. And this is what makes this type of environment so difficult to be invested in, because there are companies right now, and I think we're cautiously optimistic in a lot of areas. We're able to go out, you can find yield, you can lock in some rates. I think you're going to have a generational bond buying opportunity here before too long. I mean, this is going to be something that, granted, I know it's felt really bad last year, and a lot of people just said, hey, I'm not going to be in these areas. I think there's going to be some nice opportunities within that. And then picking stocks, which has not been in vogue. Everybody's gone towards ETF and index investing. That's going to be something that I think that if you know how to read a balance sheet, you're going to have a significant leg up on many. So we're going to talk about that and more when we get back. Talk about 4 tax smart moves you can still make for 2022. You'll listen to Real Investment Show with John Penn and Danny Ratliff. Thanks for joining us. We'll be right back after this break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for the Real Investment Show, or just click on the show links at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the Real Investment Show, Financial Fitness Friday. I'm Danny Ratliff here with John Penn. So, talk a little bit about markets. Markets still futures pointing down just a bit. Rates a little bit unchanged. Want to get to some tax moves. I know 2022 is also in the rear view. However, you still have some opportunity to potentially save some money on taxes. And John, this is one thing that we do discuss quite frequently.
Mm-hmm.
You know, as a financial advisor, there's only so many things you can control, right? Asset allocation, how you're investing, timing, which, we're not per se market timers getting all the way in or all the way out. However, we do increase exposure and decrease exposure in certain environments. But one thing that I think is often overlooked is tax planning. And granted, we're not CPAs. We don't do taxes. However, we work with a lot of them, and we do a lot of work on the back end to make sure that the moves that you make can help put more money in your pocket. Now, these aren't going to be anything that's going to be mind-blowing. It's not something that's, there's no fountain of youth here. But just timely moves that, I think that there's a lot of people that often overlook because we feel like, hey, we're in 2023, can't do anything for the prior year. And, let's talk a little bit about some of the easy, low-hanging fruit, John, that, you've been helping people with here recently.
Yeah, I mean, just, kind of the basics, a little bit about, hey, if you need to reduce your taxable income for 2022, hey, talk to your CPA or tax advisor about making a deductible contribution to a traditional IRA, right? If you're over 50, you can put in an additional $1,000, so for a total of $7,000 for 2022. I find that a lot of folks don't know that if there is a married couple, Danny, and maybe one spouse is working and has earned income, and maybe there's a stay-at-home spouse or somebody taking care of the household that doesn't, quote-unquote, have earned income, the working spouse can make a spousal contribution to an IRA for the non-working spouse, right?
Yeah, that's a great point.
So then, now if you're both over 50 years young, now that's $14,000 that you can contribute to an IRA for 2022. So just little things along those lines. And now there's, we're big fans of the Roth IRA, right?
Yep.
So now, if you make a contribution to a Roth IRA, that's not a deductible contribution. You're going to pay the tax now, right, with after-tax money. And then when that money comes out of the IRA, out of that Roth later in life, it's all tax-free. But there is something to be said sometimes when you look at your tax bracket, getting towards the end, I'll take a step back. When you look at your income for 2022, for example, maybe there's you have a little bit of a window where you can convert some money from a traditional IRA to a Roth, pay the tax now. And we're kind of talking about saving taxes, but you can pay the tax now, which we think will help you save taxes later in the future. Because again, we were talking a little bit about our crystal ball in the first session. Nobody knows what the future holds, but we don't think income tax rates will be going any lower as we get older, right?
Well, but that conversion has to be done by 12/31.
Correct.
Not something let's
correct.
Make sure we understand that that's not something we can do now for 2022. That is a hard December 31st date.
Right.
Yeah,
that's
correct.
a hard stop.
But I like what you're saying, and so you can potentially lower your tax bracket, put some funds aside. Now you do have to be cautious in the sense of if you're both contributing to a 401k at work, income limitations, you may be making non-deductible contributions. Mm-hmm. And so I do find this often where somebody says, hey, I've maxed out this, and we start going through all the options that they currently have and the income levels that they have, and they're not making deductible contributions, nor are they keeping up with it. So it's a form you have to file each year. And your CPA should be helping you with this to make sure that when you take these funds out, since you're not taking a deductible contribution, that you're not being taxed on them again. Because Uncle Sam would love you and love to tax those funds once again, but we want to make sure that you don't. So if you're making non-deductible contributions, make sure you get with your CPA, make sure you're filing the appropriate paperwork each year. That way you're not going to get double taxed further down the road. Now, another one, if you're a business owner, and this one actually has a little bit more legs to it. So the tax day this year is April 17th? Mm-hmm. If you're a business owner and you even file an extension, you could potentially set up a Roth and make a deductible contribution to it. So you're allowed as a business owner to set up a 20% of your net income for self-employment or $61,000, whichever is less, you can contribute for 2022. Now, keep in mind, if you do have W-2 employees, you will be required to contribute to them as well. And so this is one of the avenues that I think if you're a sole proprietorship, great opportunity. If it's a family business, great opportunities to put funds aside, and you're not going to have that hard date of that April 17th either. Gives you a little bit more flexibility, the ability to put more funds away. But, this is one of those deals where you want to talk to your CPA, make sure you get a very good understanding as far as what your tax burden will be so you can make those contributions and you don't overfund it. That can be a pain in the rear later trying to unwind that.
Yeah, and I like what you were saying earlier about the traditional IRA. Excuse me. Anybody, as long as you have earned income, anybody can make a contribution to a traditional IRA, but you have to be careful because sometimes those contributions are deductible or they're not deductible.
Yeah.
Right. Especially if you're a participant in a qualified plan, if you're participating in your 401k plan, there's a lot of minutia in there that you really need to pay attention to. So like you said, you really want to visit with your CPA or tax advisor to really make sure you're following the guidelines there.
Yeah,
right?
That's absolutely right. And keep in mind, I know we beat this quite a bit in the sense of, this tax code is a really advantageous right now to you. Brackets have increased, the rates have shrank. We are likely going back to the old tax code. I mean, you hear politicians talk on a regular basis about raising taxes. This will be something that will be needed because they don't produce any revenue. You do. So they're going to come knocking on your door for a bigger piece of the pie. And so the way that I always explain, a traditional IRA, a 401k, any of these retirement accounts, and why we advocate and like the Roth, because it does give you more flexibility, especially if you believe taxes are going higher. But I want you to envision this type of an account as a business. And so if John and I have a business, we're business partners beforehand, we set the arrangement of how much John owns, how much I own, and that's pretty much set in stone, where we have a very good understanding. But when you have an IRA or a 401k or any tax-deferred account, you're in business with Uncle Sam. The biggest difference here, though, is that they can change the rules anytime they want. They can go and increase their ownership. And so this is something that's really difficult to plan for because we don't know what that number will be. But assuming specific tax brackets, that could change. And so what you think you have right now for retirement, if you have $1 million in an account, you don't necessarily have $1 million because depending on how you withdraw these funds, you're going to be taxed and you're only going to get X amount. Maybe it's $800,000. Maybe you're in a really low tax bracket and it's going to be extremely minimal. Maybe you've got $880,000. But if they change those numbers, you could get blindsided. And the other things we talk about are how Social Security's tax, Medicare, IRMA, premium surcharges. Those are other issues. But just to make it really simple, you need to be considerate of when you put these funds aside today. While that's great getting this tax break, it may come back to bite you later. And so that's just one thing, as we're discussing these, I want you to really be aware of. The Roth, that's why we do love the Roth IRAs, the Roth 401ks. You can't go back and contribute for 2022 for the Roth 401k, but no income limitations. So that's another really, I think, untapped and unused tool that is gaining in popularity. And, especially as we're talking to folks that are still working, and it's a great avenue to put funds aside. Maybe it's not everything, but finding a strategy to put aside a little bit in each. Now, what's another strategy that somebody could utilize that for 2022 to put some funds aside, John?
Yeah, and I think this is your favorite account. That's the health savings account or the HSA, right? I mean, it's really, you get the triple tax benefit there when you make a contribution to a health savings account. The contribution is tax deductible. The money that's in the HSA grows potentially tax-free if the withdrawals from that HSA account are used for qualified medical expenses. And what's great about a health savings account, what I found too, Danny, that a lot of folks don't realize is, after a certain dollar amount goes into that health savings account, that money doesn't have to just sit in cash or in a money market fund. You can actually invest the assets within your health savings account for growth if you're not planning on using those assets for many years. So it's almost like an IRA that's dedicated for health savings, right? So, and you can still make contributions to your health savings account for 2022, even though we're past December 31st of last year.
All right, so break this down though, so people really get a good understanding on how this really works. So that triple tax benefit, explain that.
Yeah, so basically, the contributions reduce your taxable income. So if for individuals, for 2022, an individual can put $3,650 into their HSA. If for a family, that amount is $7,300, right? So that will reduce your income if you put that amount of money into a health savings account. If you're over 55 years young, you have the ability to put in an additional $1,000 on top of those previous amounts that I just mentioned. So there's a catch-up provision there. So it's a way, let's say you maxed out your 401k plan last year, let's say you've maxed out your IRAs, here's another vehicle. As long as you participate or are covered by a high deductible health plan, this is another avenue where you can save, potentially some additional dollars from a tax saving standpoint.
Yeah, this is a great tool. So that triple tax benefit is awesome, right? And this is my favorite account. This is one account I get really excited about. Unfortunately, they don't allow you to put a whole lot of funds into it. Now, one caveat, if you are working for somebody, a lot of times that you may be a business owner and you're doing this on your own, it's a little bit easier to dictate where those funds go. You may have to call your benefits group and say, hey, I want to make contributions to 2022. So want to finish up, talk a little bit more about the HSA, a couple more tips on how to save money for 2022 in 2023. And then I want to get into my least favorite investment, the traditional target date funds, and maybe some new options for that, the good, bad, and the ugly with that. You're listening to The Real Investment Show. I'm Danny Ratliff here with John Penn. Thanks for joining. We'll be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for the Real Investment Show, or just click on the show links at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You're listening to The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791, or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
In the economy right now, 10.8 million men have advanced degrees. Pretty good. 11.9 million women have advanced degrees. Grad school is a great place to meet the ladies. It's the new nightclub.
Hey, baby, what's your major?
The Real Investment Show podcast. Same show, your schedule.
My wife actually has advanced degrees. She's very smart. She has advanced degrees in both the memory of everything I ever did wrong and always being right.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report, Candid Coffee, and Lunch and Learn replays, plus each day's radio show. Subscribe and bookmark our YouTube channel or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to The Real Investment Show, Financial Fitness Friday. I hope everybody's off to a great start. I know weather is kind of all over the place these days. It's hot, it's cold, it's hot, it's cold.
Had a little fog coming in this morning,
Yeah,
a little
there was
mist.
a little fog this morning.
Driving through the fog. It's like a bad movie or something.
It's like that every day.
Yeah.
So, hey, talking about some tax tips to help save you guys some money that you can still do for 2022. So, discussed, potentially the potential ability to put funds into a traditional IRA for the prior year, even a Roth IRA up until the tax date. Putting funds into business IRAs like SEPs, Simples, these are things that you can still do. But we were talking about the HSA, and this is my favorite account because you do get the triple tax benefit. And one thing do want to make sure you guys take note of is that while you can put $3650, so $3,650 for an individual into an account, for a family $7,300. If you and your spouse both have one, that doesn't mean you can both put $7,300 into it. So be careful. This is where the IRS may come back and get after you a bit. But one thing that I think that is really important is that this is not an FSA. There's a lot of confusion, John, between FSAs and HSAs. So FSAs are flexible spending accounts. You're typically going to need to spend those throughout the year. Some have a hard deadline of December 31st. Some will allow you up until about the tax day, or usually about March 1st, to go ahead and spend those funds, because if you don't use it, you lose it on an FSA. Mm-hmm. An HSA allows you the ability, similar to a retirement account, to roll these funds over. And so the idea right now, we would encourage you, because of what we know to be how much people spend in retirement on healthcare, we would encourage you to go ahead and try not to spend the funds you put in here, pay everything out of pocket, and let those funds grow. Now, we generally want to put, and what I advise people generally is you want a year or two of healthcare premiums set aside in a safer investment. Because what happens if you lose your job, something happens? Ideally, I'd still prefer you not touch that. However, we know life happens. So you'd want to put enough in those accounts in a safer investment, especially like you were talking about earlier, John. You can actually get some yield. Mm-hmm. You may have to search for it because sometimes, your limitations are, your investment options are limited. But this is an area where I think if you put some funds set aside in a safe spot, then you can go and invest on top of that, because, we do want you to see that growth. Keeping up with inflation is becoming a lot more difficult, especially you've got inflation, you've got bad markets. But I think you've got the wind at your back in a couple ways here before too long. So HSA, don't rule those out. Don't use them like an FSA. Continue to put funds aside in that area. We look at like HealthView Services says the average couple at 65 is going to spend over $350,000.
Yeah.
Plenty of studies that show you're going to spend between $300,000 and $400,000 on healthcare in retirement, and that's a huge number. And I think that scares people to death.
Yeah, you have to watch the little rule here around HSAs. That is, I know where I mentioned earlier that HSAs are almost like an IRA for health savings. Some different rules when it comes to taking a non-qualified withdrawal from an HSA. You have to watch that magical age of 65. If you take a withdrawal from a health savings account before you're 65 years young, and that withdrawal is for a non-qualified medical expense, on that amount that comes out of the HSA, you'll pay tax plus a 10% penalty on that. So you have to look at age 65 for that. But if it's a qualified medical expense when it comes out of the HSA, Danny, as you mentioned, that's tax-free money.
Yep. And the other caveat too is that if you are over 65 and take it out for non-medical use, then you are only going to pay the taxes on it, right? You don't have that 10% penalty at that point.
And actually, I misspoke. It's a 20% penalty, not 10.
Yeah.
Yeah.
It's not nice.
Yeah. So that's even worse.
But I think if you use these accounts properly, these are a great tool in the toolbox. I think, if we can have multiple ways that you can make distributions, this is going to help, right? We want as much flexibility in retirement to mitigate taxes, and this is a really good way to do so. Any final parting words on HSAs?
We like them. I think that make a lot of sense, especially, but if you have to look at, where are you maximizing your other savings first? And I like what you said, Danny, about, hey, if you have this money in an HSA, you have a lot more flexibility on how you can invest it. I like what you said about having a year or two of expenses set aside, safe, just earning some interest right now. You can pick up better yields with the higher interest rate environment that we're in. And then for anything that's over 2 years, you can invest it for growth.
Yeah, no, it's great. You can also use these funds for, long-term care insurance. You can use it for Medicare expenses. There is a lot, and especially as we age, we're going to use it more and more. Don't use it. You're not going to lose it. Let these funds continue to roll, and that way you have the flexibility in retirement. So one last tip. What is something, and this is something I think that a lot of people in this stage right now are saying, nothing I can do, not going to do it. What is it?
Oh, itemizing your taxes versus maybe taking the standard deduction. But that standard deduction is pretty healthy, especially for a married couple. But you can still, depending on the size of the mortgage of your home, you can still, deduct interest of up to, $750,000 of mortgage. It used to be prior to the date you used to be able to, itemize the interest if the loan was $1 million. That was changed to $750,000. And you can still deduct, $10,000 for property taxes, state and local income tax. And don't forget that medical expenses that exceed 7.5% of your AGI, of your adjusted gross income, can also be deducted. So if you're close, you have to just take a look at your standard deduction, take a look if you itemize, and which one is more beneficial.
Yeah, I think because of the increase in the standard deduction, many people just said, "Oh, forget it. I can't write anything off. I'm not going to itemize." And I feel like there's probably a lot of money left on the table because it does require a little bit of work. But this is something that, our goal is you want to keep as much money in your pocket as possible. So I think too often we're so worried about returns and what markets are doing instead of also controlling what's the outflow. And this is a good way to control a little bit of that. And, I know I don't want to give Uncle Sam any more than you have to, right? And I don't want you to either. So explore these tax tips, contribute to the traditional IRA if it's possible, if it makes sense. We do like the Roths, yes. Business owners, SEP IRAs, simple IRAs, max out the HSA for 2022 if you have not already. Be prepared to do that this year as well. And before we jump to another segment here, I want to touch on that just a little bit more. So there are times, as we're talking about, we talk about the hierarchy of savings. And we actually had a webinar yesterday talking about raising money-wise kids. So some tips about really more about, money scripts and traits. Like, what are your money scripts? Do you have money focus, money avoidance? What do you do really well? And I think we all have a little bit of all of these in some ways. But noticing in your children, how to look at this. And one thing we talked about, and a good question was the hierarchy of basically like, hey, I have a college kid, just graduated, no debt. What's the best place for them to invest? And I'm kind of getting off on a little bit of a tangent here, but this is why it's important to understand the hierarchy of savings. And first, we want to invest in an emergency fund. We may advocate for a financial vulnerability cushion, meaning a little bit more than what the rules of thumb have been. So depending on somebody's job, 3 to 6 months of expenses, maybe even 12 if you're if you're the breadwinner. I think this is important. But then also it goes back to what kind of job do you have? Is it volatile, your pay? If like we talk about, if you're a tenured professor, you probably don't need as much as somebody who's on straight commission. This is something that I think that needs to be considered first, right? So hierarchy of savings. But then, we're talking about the HSA, and here's where I'm going with this, is that we're contributing to a 401k, you want to at least get the match. And a lot of companies are now matching an HSA as well, the health savings account. Mm-hmm. So we may make an argument that you go and contribute. If you're not going to max them all out, which many people aren't, go get the match in the 401k, go max out the HSA, then go back to the 401k. And if you have bandwidth for additional investments, have at it. There's plenty of options and opportunities. Rich and I are going to work on kind of an actual a flow chart, so to speak, just kind of breaking that down to really make it very clear. But I think that's something that's often overlooked, John.
I do too, and we have two daughters, Danny. They're both in college. Our oldest will be graduating this semester. Hallelujah! And so we've already
just got a pay raise.
Yeah, that's it. I don't dance well, but you will see me dancing out in the streets. And maybe for that day, I'll buy some cowboy boots. But
all right.
But so we've even been talking a lot of questions around and just with clients and parents with their children that are about to graduate, or children that have just started their first job, and it's very much the principles that you're just laying out there, setting money aside for savings, making sure that there's plenty there for a rainy day. And then, hey, with their retirement plans options at work, what is this traditional 401k? What is this Roth 401k? How do these work, and what are the differences? And is there a better approach for me to take? And so there's a lot to think about.
Yeah, there's so many moving parts, and but that's why I think this is so important to make sure that you're taking the actions and taking the time just to understand what you have available, where you can put funds, what's the most beneficial for you. My goal would be is that if you're still working and you have some years left, that everything you have is not in a pre-tax account, and you don't have much flexibility down the road. We want to go ahead and start thinking about building that financial plan, understanding where you're putting funds, having multiple options to withdraw from. So, as promised, next segment, my least favorite investment, the traditional target date funds. We're going to get into that and tips and things other advisors are saying, good and bad. What does it mean to you? We'll be right back. Thanks for joining.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for the Real Investment Show, or just click on the show links at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the Real Investment Show, Financial Fitness Friday. Happy Friday, everyone. So talked a bit about some tips you can do still for 2022 prior segments. If you're just joining, thank you. We're going to get into my favorite investment option. No, we're not. So a lot of talk about target date funds. And this seems to be the easiest place to put funds. It's a set it and forget it. And it is the reason these funds are there is because they're the qualified deferred investment option for the trustees or plan administrators to take risk off of their back. Meaning, hey, we gave you options. So meaning that if you don't pick something and you're putting funds in, these are where the funds will typically automatically go. And in theory, they're not all bad. In practice, I think they're terrible because it is a set it and forget it. It is a overly diversified option typically. And now, granted, we're different in how we manage money, so we probably view this through a different lens than most. But the main selling point on these types of funds are that each year or several years, they have what they call a glide path. Over time, they start to reduce your risk, take the exposure out of stocks, move it into bonds. However, that glide path is not always your friend, and I don't think that it moves nearly as quickly as most people think. You know, we've talked about this pulling up a lot of different funds in the past and kind of sharing side-by-side comparisons, and I'm not going to bore you guys with that today, but a lot of accounts right now where it would assume that you are in retirement have a lot more stock exposure than I bet you'd think. And not to mention, this last year probably got completely beat up because of the fixed income exposure as well, which everybody did, right? Worst year in fixed income since 1788. I mean, you can't say that without thinking, wait, 1788, what? What is that? Is that a new a Yellowstone type deal?
Is that that's a prequel to 1883. My goodness.
Is that Taylor Sheridan?
Man.
No, this is a fixed income market.
Yeah, I mean, so I was just visiting with a lady this week, Danny, about looking at a target dated fund, and it was, I'm not going to mention the fund company name. It doesn't matter. It's not the fund's fault. It's really nobody's fault. But it was a target dated 2025 fund, right? Okay. Well, it's 2023, so fund has a target date 2 years.
Meaning in 2 years is the ideal or optimal retirement date, right?
Right.
Okay.
So the way the client read it was, this was a 2-year investment, which is a short-term investment, meaning, well, this should be a pretty safe, conservative. You know, she thought maybe it matured like a CD in 2025.
You know what? That's a great point, John. I don't think I've ever thought of it like that. Obviously, I mean, being, the stuff we deal with day to day, and I'm not sure I've ever had anybody describe it like that as far as what they thought. So that's a really good point.
And I can see how it can be interpreted that way, right? And so, and she was concerned because the performance of the fund last year, of course, it was a grinder of a year for a market. It just wasn't fun. And this fund was down 15.5% last year. And she said, I thought I was really putting my money into something very safe, but nobody ever really explained what the fund was. And she admitted that she really didn't ask about it either, right? But that fund, it's a target date of 2025. The amount of equity exposure in that fund, it still has an allocation of 55% to equities. And of that equity percentage, half of it is in U.S. domestic stocks. The other half is in the international markets. And there's quite a bit of bond exposure in there too. So it was just a double whammy all the way around for her last year. Right. And I just felt bad because she really thought it was an investment that was supposed to be something that would mature, almost like a CD in 2 years. And that's the first time I ever really had anybody interpret it that way, but it can happen.
Absolutely. Yeah. And so the issue is that, we're seeing, we keep getting these studies talking about the average investor's returns for 2022, and they're not good. I mean, we've heard some that are well over 30%. Fidelity just came out the new one saying that the retirees lost 23% of their 401k savings in 2022. S&P was down 18.
Mm-hmm.
Bonds were down 13.
Mm-hmm.
NASDAQ was down 32. And I think you get overly aggressive on the tech side, which is likely, right? It's done so well. And if you're not watching it, I get it. And I think one of the bigger mistakes that most people make is that we look back at previous returns to invest. And, the number one caveat, you look at any of these fun fact sheets, past performance does not guarantee future results. And this is a big reason why. But these target date funds I think they can be problematic in the way people view those. And like you said, the interpretation of it is much different for most. And so last year was a year that is tough, right? Because everything went down but cash. But if you look at these funds, they're not excluding certain areas because of the market environment or the economic conditions. They're always going to be blanket invested, and they're going to whittle it down very slowly, but it's probably not at the pace you think. So take a look under the hood when you look at this. But so reason we're getting this, John Chauvin, Emeritus Charles Schwab Professor of Economics at Stanford University, and fellow author Daniel Walton have now made a very strong argument and did a study and analysis that instead of using target date funds, you should have deferred lifetime annuities inside of the 401ks. There's actually been legislation to allow for this. However, it has not been broadly adopted. This is something, I think it's pretty tedious. There's a lot of work that goes into it. And so we haven't seen the use of deferred annuities within this. And so historically, the way this would look is it's kind of like setting up a pension. And I know they don't like that word, so to speak, but you're giving them these funds and they are going to guarantee you a paycheck. Historically, for the remainder of your life, or maybe on both you and your spouse. There are some that offer cash refund, which is the only way I would do that. Meaning that because like the traditional pension, if you don't take the lump sum, you could get one payment and God forbid something happens to you and your spouse, bam,
money's gone.
Yeah, your heirs don't get anything. But on these, if you do these right, I think there's some nice benefits to that in the sense that if that happens in that case, your kids, your heirs, your beneficiaries, whoever that is, are still going to get some funds. But what they're advocating for is taking 10% of the balance every 2 years, once you turn 60, and putting those into a deferred lifetime annuity. And that it essentially will be turned on when you reach retirement age. And I can see some benefit to that. However, I think the problem is the way most of these 401ks work, you're not getting a whole lot of guidance. So what type of education is going to be done surrounding this? I can see some pitfalls here, John, and that's what gives me a little bit of concern. I can tell you right now, I've got clients who have deferred annuities, and usually they've been used for only a small portion. And I don't ever think it's something you put everything into. And we're not big annuity salesmen. We're not big. We're not really big on any of this stuff, right? We want to be experts on it all and understand how these different types of investment vehicles can be used. And everybody's different. Some people may not need it at all. Some may not want it. Some people, something like this could make sense to kind of create that floor and provide for lifetime income. Now, with these, though, my concern is, one, there's no education around it. If you're just plopping it into the 401k, all of a sudden you have the ability to go buy it. What are the requirements on the back end of this? What are the fees? Those can be historically rather high, right? That's a big reason a lot of people stay away from these types of investments. What's the ability to get out? I mean, what do you see from a problem perspective?
Yeah, when I was looking at this, at first I was like, man, I don't like this at all. And then it started to grow on me a little bit where I could see maybe for the right client in the right situation where something like this could be beneficial. Especially if you have, a period of bond prices, that are, as interest rates are changing, that affects the prices on bonds, that affects the underlying investment value of funds within your retirement plans. I could see where if you're incorporating these deferred annuities for at least that portion of the assets that are in the deferred annuities, that money could potentially be more stable, right? Because at some point you're just going to turn on the income stream and that's going to be fixed. But then to your point too, Danny, I started thinking about there has to be so much education around this because so many times even when we're putting financial plans together today, where folks are receiving a pension or they have the ability to receive a pension, there's not a lot of education around what their different pension options or annuity options are, because usually it's, hey, just give me the maximum amount that I can receive. But then heaven forbid I receive one payment and then my spouse doesn't get anything.
Yeah.
Right. Or my heirs get nothing. Right. So there's got to be some education around what are your distribution options. Yes, you may not get the full benefit if it's just based on my lifetime, for example. If it's, if the income stream is based on myself and my spouse, I'm going to earn a little bit less now. But heaven forbid, if something happens to me, I know that 100% of that benefit or 50% of that benefit or 75% of that benefit, whatever you choose, that my wife is still going to have an income stream if I should happen to predecease her. And I'm afraid that if there isn't some real help or education around that, some folks could be really setting themselves up for a disaster.
Yeah, I think that's exactly the point. And how many times when you do a financial plan and you see all these different types of annuities that somebody's purchased, and you ask them, okay, how does this work? I'd say 99% of the time, most people are not quite sure.
Right.
And because it's a lack of communication many times, because once you've bought one, sometimes it's just kind of like set it and forget it.
Mm-hmm.
Oh, don't worry about it. It's good. So a lot of moving parts. I think things will be changing in the retirement industry, and these are things that you need to be kept up to speed on. So be cautious when you look at this. If you open your 401k and see this new investment option, say, I'm not sure what this is. Call your advisor, call your benefits group, call us, go to realinvestmentadvice.com, ask a question. We're always happy to help. Hey, thank you guys for joining us today. I know we got into some tedious information. Always a pleasure to spend the morning with you guys. I'm Danny Ratliff, John Penn. Have a great weekend. We'll see you guys next week.